the Fed indicated that we're going to get at least 2 more rate cuts between now and the end of the year. So bullish, bullish, bullish. And so gold's got no place to go but up. Silver's got no place to go but up. But let me get to these 3 other very significant, news items of the week. One is I watched an interview with Stephen Moran this morning on CNBC. Now, Stephen Moran was the head of Trump's economic advisors, who is now serving a stint as an FOMC member. So, he's wearing 2 hats, although technically one hat, he's got checked. He's going to go pick it up. So it's obviously a big compromise of Fed independence to have a member of the Trump administration infiltrating the FOMC. But 2 startling comments that he made. One was he said that rates need to be much lower because he says the Fed is way above neutral. And not only is he wrong, not only are we not way above neutral, we're below neutral. We're too loose. The Fed should have hiked rates, not cut them. That's what the market is telling you. That's what the long end of the bond market is telling you. That's what the gold market is telling you. Nobody wants to listen to those market signals. Look at the money supply. Look at what's happening with consumer prices, right? We have high inflation, well north of 2% and headed higher. But I think an even bigger admission that should be even scarier if you're holding US dollars and not gold is that Moran said that in answer to a question about the dollar, he said that one of the Fed's mandates is not a strong dollar or to worry about the exchange rate of the dollar. He says there's nothing in the Federal Reserve Act that mentions the dollar and that it's not up to the Fed. He said that the policy regarding the dollar, that lies with the president, right? Not the Fed, which should be very scary because if the Fed doesn't care about the value of the dollar, how is it going to deliver on its primary mandate of price stability? Because price stability relies on the stability of the dollar, because prices are a function of the value of the dollar. If the dollar is losing value, you need more dollars to buy stuff. So in a way, when the Fed is mandated to maintain price stability, it is also being mandated to maintain the purchasing power of the US dollar. So to say that the dollar is not a part of the Fed's mandate either means you don't understand what the Fed's mandate is, or you're just lying. And so either, it's one or the other, but there's no, third option. So he's on the Fed, and Trump is going to appoint a new Fed chairman that is going to share that perspective. In fact, one of the president's closest confidants, or was at one time, he came out this week in favor of the president nominating Scott Bessent to be Fed chairman while he is still Secretary of the Treasury. In other words, Scott Bannon thinks that the chairman of the Federal Reserve and the Secretary of the Treasury should be the same person. One guy wearing both hats, or gal, depending on who's there. That is a horrible idea. I mean, often those two work together, but they shouldn't. There should be like a Chinese wall there. In fact, the Secretary of the Treasury, of the Chairman of the Fed, needs to push back against reckless monetary deficits and fiscal policy. They shouldn't be working together, and certainly they shouldn't be the same person. But that's what they're advocating. So this is a real collapse of the perception of Fed independence. Even if the Fed wasn't independent, there was a general belief that it was. And now that's falling apart because they're pulling back the curtain and they're showing everybody that there really is no Fed independence. So I think the dollar is going to tank, but more significantly, gold is going to rally and rally big. The U.S. Treasury, how is the U.S. government going to finance these deficits? Because foreign central banks are no longer buying treasuries. They're selling them. They're buying gold. The Social Security Trust Fund doesn't buy treasuries anymore. It has to sell them to cover its shortfall. And now individual investors aren't going to buy treasuries because if they have 40% and they have to go down to 20%, they're not buying anymore. They have to sell what they got. And the Federal Reserve is technically still selling treasuries because they're still doing quantitative tightening. They're doing it in a very small amount, but they're still doing it. So right now, the Fed isn't buying. So who's going to buy? Maybe they're going to pressure the banks to buy more treasuries. Well, then they're going to have to make fewer loans. It's going to crowd out the private sector. Now, maybe hoping that the stable coins are going to pick up the slack, but they're not. This is all a bunch of BS. There isn't all this demand for stable coins. That's just a bunch of hype so that the president's friends can make money selling all this crap and selling stock in companies that are creating all these stable coins that nobody really wants. I mean, why would you want to hold your dollars in a stable coin and earn no interest, right? At least if you hold your dollars in a money market, you earn the interest. If you sell the money market and buy a stable coin, now the stable coin issuer keeps your interest and you get nothing. But to the extent that stable coins buy treasuries, it's because mutual money market funds aren't buying them, because people are going to take their money out of a money market and use it to buy the stable coins.
So the Fed has basically telegraphed that we're going to get at least 2 more rate cuts between now and the end of the year. And of course, the market hears that and screams, bullish, 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 right? Because the only thing markets seem to care about anymore is cheap money. Doesn't matter if inflation is raging, doesn't matter if deficits are exploding, doesn't matter if the dollar is tanking. All that matters to Wall Street is that the Fed is going to make borrowing cheaper, so party on. Well, the problem is, the more the Fed cuts, the worse the fundamentals get. And if you own gold and silver, that's exactly what you want, because the Fed has basically promised you a weaker dollar and higher metals prices. Gold has nowhere to go but up. Silver has nowhere to go but up. And it amazes me how few people understand that. Now let me touch on 3 significant stories from this week that hardly anyone in the mainstream is talking about. The first one came from an interview on CNBC with Stephen Moran. Remember, Moran was one of Trump's top economic advisors, and now he's somehow sitting on the FOMC. He's wearing 2 hats. Well, technically 1 hat at a time, but you get the point. It's a revolving door between politics and the Fed. If you thought the Fed was independent before, this should put that myth to rest. Anyway, Moran made 2 startling comments. First, he said that rates need to be much lower because the Fed is way above neutral. According to him, the Fed is too tight. Well, not only is he wrong, he's spectacularly wrong. The Fed isn't too tight, it's still too loose. We're below neutral. We should have hiked, not cut. That's what the market is telling you. That's what the long end of the bond market is screaming. That's what the gold market is saying. Inflation is well north of 2% and rising. The money supply is expanding again. And yet Moran is saying we need to cut? This is why I always say the so-called experts are clueless. They don't listen to markets, they listen to politics. But here's the even bigger bombshell Moran dropped. He was asked about the dollar, and he said, point blank, that the Federal Reserve has no mandate regarding the dollar. Nothing in the Federal Reserve Act about the exchange rate. He said, that's up to the president, not the Fed. Now think about that. If the Fed doesn't care about the value of the dollar, how can it possibly deliver on its mandate of price stability? Prices are nothing more than the dollar's value relative to goods and services. If the dollar is losing value, prices rise. So maintaining price stability is literally the same thing as maintaining the dollar's purchasing power. For him to say the dollar isn't part of the Fed's mandate means either he doesn't understand the mandate or he's lying. Those are the only 2 options. Neither is comforting. And now Trump is preparing to appoint a new Fed chairman who will share this same perspective. In fact, one of his closest confidants came out this week suggesting that Scott Bessent should be Fed chairman and Treasury secretary at the same time. One guy wearing both hats. Can you imagine? That's like making the arsonist the fire chief. Historically, there's supposed to be a firewall between the Fed and the Treasury. The Fed is supposed to push back against reckless fiscal policy. Now, I know in practice they've always worked together, but at least they maintain the appearance of independence. That illusion is collapsing. They're pulling back the curtain and admitting what I've been saying for years. The Fed isn't independent. It's political. It's a tool of the administration. And once you admit that, the dollar's credibility goes out the window. If the central bank doesn't care about the dollar and the Treasury doesn't care about the dollar, then who's left? Nobody. Which means the dollar is going to tank and gold is going to soar. The government is running trillion-plus deficits. The debt is over $36 trillion, and the usual buyers are gone. Maybe they'll pressure the banks to load up, but then banks won't be making loans to the private sector. Maybe stablecoins will step in. But that's a joke. Stablecoins are just a gimmick so insiders can cash out of companies that issue them. Why would anyone want to hold a dollar in a stablecoin earning zero interest when they could hold the same dollar in a money market fund earning 5%? The only reason is if you're being sold hype. So at the end of the day, the Fed itself will have to be the buyer of last resort again, which means QE, which means money printing, which means inflation, which means gold and silver go through the roof. That's the reality. The mainstream media won't talk about it, but the charts will, the markets will, and anyone with an ounce of common sense will.
Gold finished the week up another 1.1%, not at a new record high, but just barely. I mean, we closed in gold right below 36.90, maybe 36.85. We touched 3,700 a couple of times over the course of the week, but we weren't able to get above it. I have a feeling we'll gap above it on Monday and maybe never look back. Silver was even stronger, up 1.8% on the week, but all of that gain today, because today's move in silver was 2.8%. So meaning silver was actually down 1% on the week going into today, and it closed up 1.8% because of a 2.8% move. Silver actually closed just above $43 an ounce. So we hadn't even been above 43 in 14 years, and now we closed above it. Year to date, just to put these gains in perspective too, gold is now up 40% this year alone in 2025. Silver is up 48%. These are incredible returns for precious metals, especially given that last year was also a very good year. But the only thing that's outperforming gold and silver are the gold and silver mining stocks. Today alone, both the GDX and the GDXJ jumped 5%. 5%. We didn't even have really a 1% gain in the price of gold, or almost, I guess it was about 1% because it was $40, so a little over 1%, but 5%. So we had 5 times the move in gold stocks today as we had in gold. And the GDX closed at an all-time record high, never been this high. And the GDXJ is the highest it's been in 13, 14 years, something like that. On the week, the GDX was up 3.75%, and the GDXJ was up 2.2. The star of the day was Barrick Gold, which was up 10% in one day. That's rare for a company that big to be up 10%. Normally, you might see some smaller companies, although all the gold mining companies are small when you compare them to the tech companies. But in the mining universe, Barrick is, I think, the second biggest, following Newmont, which, was still up almost 5% on its own today. So not too shabby there. But these are all big moves. Year to date, the GDX is now up 113%, and the GDXJ is up 115%, right? So these stocks are doing better than tech stocks. Newmont is the best performing stock in the S&P 500, but you would not know about that if you listen to the mainstream financial media. In fact, there was very little, if any, talk at all today in the mainstream financial media.
Let's keep going, because the implications here are enormous, and honestly, they deserve more time than I usually give them. The Fed is boxed in, and it knows it. Inflation is officially reported around 3%, but everybody who actually lives in the real economy knows it's higher. Just go to the grocery store. A cart of food that cost $100 3 years ago now costs $160. Insurance premiums are skyrocketing. Rents are up double digits in many cities. Property taxes are going up to cover municipal deficits. So when the government tells you inflation is under control, that's not analysis, that's propaganda. CPI is designed to hide reality. If we use the same methodology we used in the 1970s, inflation today would be north of 8%. And into that environment, the Fed is cutting rates. That's not policy, that's insanity. It's like throwing a drowning man a barbell. Now add Trump's advisors openly admitting that the Fed doesn't even care about the dollar. That's astonishing, because for decades, the whole global financial system has rested on the idea that the dollar is stable, that the Fed is independent, and that U.S. debt is risk-free. None of those things are true anymore. The Fed is political. The dollar is unstable. U.S. debt is a ticking time bomb. What do foreign central banks do when they realize this? They sell treasuries and buy gold. And that's exactly what's happening. The People's Bank of China has been reporting gold purchases for almost 2 years straight. Russia has been hoarding gold. Poland just raised its gold reserves target to 30%. Turkey, Kazakhstan, India, all buying gold, not dollars. This is de-dollarization in real time. It's not a theory anymore. It's a trend. And every dollar sold means more pressure on the treasury market. Every ounce of gold bought means more upward momentum in metals. Now let's focus again on silver, because silver is where the fireworks will really be. Silver is up nearly 60% year to date. It just blasted through $46 and is racing toward $50. And I've been saying for years, once silver breaks $50, it won't look back. That number is psychological. It's the level where retail finally wakes up, where mainstream media finally runs with the story, and where panic buying begins. Remember 1980? Silver hit $50 when gold was $850, a ratio of about 17 to 1. Today, gold is near $3,700, and silver is still under $50. That's a ratio of nearly 75 to 1. If silver just reverts to the 1980 ratio, you're talking about $200 silver. And given today's industrial demand, solar panels, electric vehicles, electronics, $200 might even be conservative. And silver is a tiny market. All the above-ground silver bullion in the world is worth less than Apple stock. One big institutional allocation, and silver gaps higher overnight. That's why I've always said silver doesn't just go up, it explodes. It's volatile. It's emotional. And it terrifies the establishment because it shines a light on the fraud of fiat. And let's talk about psychology, because this matters. Right now, most retail investors couldn't care less about silver. They're too busy chasing Tesla or Nvidia, convinced AI will make them rich. But once silver breaks $50, those same people will panic. They'll text their brother-in-law who's been stacking coins for years, asking where to buy. Dealers will run out of inventory. Premiums will spike. ETFs will balloon. And that's when you'll see $75, $100, $150 silver in a blur. It always happens this way. Retail is late. They mocked gold bugs in 2018. They mocked silver stackers in 2020. But when the mania hits, they're the first ones storming the coin shops, begging to pay any price. By then, the smart money is already bought. This is why I keep saying, don't wait. Don't ask CNBC for permission. Don't wait for Jim Cramer to say, you know what, maybe you should buy a little gold. By then, you'll be paying triple. Now let me give you some history. In the 1970s, we had stagflation, high inflation, weak growth, political turmoil. Gold went from $35 to $850. Silver went from $1.30 to $50. That's almost a 40 times move in silver. And the fundamentals today are worse. The debt is bigger, the deficits are bigger, the entitlement obligations are bigger, the Fed's balance sheet is bigger, the political divisions are worse. If metals could do that in the 1970s, what do you think they can do now? Or look at Weimar Germany in the 1920s. As the mark collapsed, people rushed into gold and silver. A single ounce of gold ended up buying entire blocks of real estate. I'm not saying hyperinflation like Weimar is guaranteed, but the trajectory is similar. Too much debt, too much money printing, not enough productivity. And then there's the 1930s in the United States, when FDR literally confiscated gold from Americans because the government was bankrupt. They revalued gold from $20 to $35 an ounce overnight. That's a 75% devaluation of the dollar in one stroke. People who held gold outside the system preserved their wealth. Everyone else got robbed. That's why I say, own your metals physically. Don't just trust paper promises. Now, I get a lot of questions about how to invest. Should you buy coins, bars, ETFs, mining stocks? My answer, it depends on your risk tolerance. Physical metal is insurance. You own it to protect yourself against system failure. Mining stocks are speculation. They can go up 5 times, 10 times in a bull market, but they can also get crushed in a downturn. ETFs are convenient, but they're still paper promises. Personally, I think everyone should start with physical. Coins and bars you can hold. Then if you want leverage, add miners. And the miners right now are finally confirming the bull market. For years, people said the rally wasn't real because miners were lagging. Not anymore. GDX is up 120%. GDXJ is up 125%. They're tripling gold's return. That's classic bull market behavior. So what's the bottom line? The Fed is trapped. Inflation is entrenched. The dollar's credibility is shot. The deficits are unfinanceable. The treasury market is fragile, and the rest of the world is moving to gold. In that environment, gold and silver don't just go up, they explode. And I'll say it again. Every financial crisis looks obvious in hindsight. In 2008, everyone suddenly knew housing was a bubble. In 2000, everyone suddenly knew dot-coms were absurd. In 1929, everyone suddenly knew leverage was unsustainable. Well, in 2025, everyone will suddenly know fiat was a fraud. Don't be the person who figures it out after the fact. Don't wait for history to slap you in the face. Protect yourself now. Buy your gold, buy your silver, because when the music stops, you'll be glad you did.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.